Well, by all means, a very important session here in Gaborone in Botswana. So it's about tackling a myriad of challenges facing the African continent, especially at this very critical time where the global uncertainties, whether you're looking at the conflicts, but also economic volatility and many other issues as well. But to really explore this further on this very last day here in Gaborone, we're joined by Ms. Schwidrowski, of course, from the United Nations Economic Commission for Africa. So once again, ma'am, thank you so much for your time. So first of all, I mean, a very important time in tackling all these challenges. So far, let's hear your input. What are you getting from this particular gathering?
Yes, so I think topic of this conference is particularly timely, global uncertainties and what can Africa do to be prepared for the future. And it was observed by several presenters in several sessions that basically the shocks that the continent has been experiencing, and I would say for over a decade, are not really internal country level shocks, but they became regional or especially global. So global financial crisis was one of the first examples of a global shock that has hit Africa, shock that Africa did not create. Then of course the commodity price shock of 2016. Then we had the COVID, etc. So these very large shocks really require collective solutions. So one area that the conference focused on, based on the work done in the United Nations Economic Commission for Africa, where our Deputy Executive Secretary is actually co-chairing the high-level working group on reforming the global financial architecture, and also it was done by African Development Bank, is how to reform global financial architecture so it serves better Africa's needs and becomes more transparent and also more fair. So there are several elements to reforming the global financial architecture. One very important one is actually raising Africa's voice. So to make Africa heard more and united Africa's voice. And the relatively recent admission of African Union to the G20 is a great opportunity. But beyond the Africa voice, there is also reform of basic access to finance. So if we look at the IMF and the quota Africa is having, it's really, does not correspond neither to its needs, but also to its rising importance in the global economy. A very big challenge is not only for Africa, but including for Africa, is the large public debt burden, and it's both external debt but also domestic debt, and increasingly in some countries also contingent liabilities. So the question is, how can the global debt architecture be reformed? So we saw there were some solutions like the debt service suspension initiative in 2020, but it was insufficient. It basically postponed the problem because it froze the interests for a while, but then they became repayable actually when the Russia-Ukraine conflict started, and there were other challenges at the time. And similarly, the G20 common framework, also we see from very low uptake of the framework, less than 5 countries, actually 3 countries in Africa have applied for the framework. So why is it, there needs to be a comprehensive solution that is much more friendly to African countries. One of the challenges, again, that there is mostly focus on restructuring the interest rate maturity, but that probably needs to be more fundamental solution, looking also at reducing the principal. And then going forward, how can we assure that African countries can borrow at scale at reasonable cost? Because right now, the main challenge, it may look similar like the debt crisis of mid-2000s as far as the debt to GDP level, but the borrowing costs today are much higher, reflecting very much higher share of the debt from the private creditors. So how can this be, corrected going forward? So one area is actually additional access to concessional funding, and that's where international institutions play a role. But another one is also improving credit ratings of African countries, because it's these credit ratings that are associated with very high borrowing cost.